It's time now for On the Radar, a closer look at what a money manager is watching in the markets these days. John Zechner is back with us. He, of course, is with Zechner Associates and is a veteran watcher of markets. And John, you wanted to talk to us about gold and Bitcoin today.
Yeah, because both are referred to as stores of value. And I sort of wanted to look at that argument and sort of, see a little bit more of it. And yes, they both are stores of value, different way. I mean, the tagline a little bit, yeah, Bitcoin is a store of value for optimists, and gold's the store of value for pessimists. So I don't know if that really fits. And there's also a demographic to it. And when I look at the holders of Bitcoin are mostly the younger demographic, versus gold is on the other side. And, hey, my next birthday is going to have a 7 in front of it. So, which bucket I fall into. So now, but when you look at them, okay, they're mostly driven by investment demand rather than utility demand. I think gold's got a bit of an advantage on that one because there still is jewelry demand, which you don't see on the Bitcoin side. Everything is just, Bitcoin goes higher because there's another investor ready to buy it at a higher price, as opposed to any deployment we've seen, a large basis in terms of the utility of cryptocurrencies in general and Bitcoin in particular. I haven't seen any rollout like that. I don't see software companies talking about it. So on gold, yeah, relative to the annual or the total supply, jewelry demand is not a big driver, but it sort of does match close to annual global production. So, there's a bit of a better argument there on the gold side. And the holders, I mean, it's mostly ETFs on the Bitcoin side, which can be more trading oriented, faster money going in and out. The gold, the bigger buyer has been the central banks, obviously diversifying away from, the risk of fiat currencies, probably the US dollar in particular. And they will tend to be longer term holders. So I think you've got a more stable investment demand. And you haven't even really seen yet ETF flows on the gold side, which I think you may. So, I would argue a bit more on the store of value. Gold still would stick out as a better one. And I think Bitcoin and other cryptocurrencies, they still have to prove themselves in that regard. I think ultimately the big driver for them has to be more the utility aspect, the blockchain technology and the use in transactions and elsewhere in order to make this viable longer term. On the golds, the other advantage is the gold stocks. And I heard somebody on this network a couple of weeks ago talking about oil stocks and why they like them and all of that. It says because it's cheaper to buy oil on Bay Street than it is in the Permian or in the Duvernay and the Montney and whatever. And I agree. Same story for gold. Right now, it's way cheaper to buy gold, in the market. It's easy for gold companies. It's cheaper to buy than to build because you look at it. I mean, what mine has come in under budget? In the past number of years. You got environmental concerns, labor, capital costs, everything escalating, geopolitical risk on top of that. So I think the gold stocks are reflecting a lower valuation. I think we'll start to see more corporate activity. I think what has been the best senior gold stock over the last couple of years has been Agnico. Yeah. And what did Agnico do? They did some really good acquisitions. I mean, in Kirkland Lake, they bought Kirkland Lake, which it in itself has just bought the Detour mine. They added quality assets through the market, and they were getting rewarded for that. So I think we may see more of that. So
critics say that the gold industry, has a history of acquisitions that have not been shareholder friendly, that have not added value. Do you agree?
Yeah, there has been a history of that because a lot of them have been more the political jurisdictions that they went into. I mean, Barrick buying Equinox, in West Africa and things like that. So, some of the Kinross acquisitions have worked out that way. So, I think they have to be very careful. I think geopolitical risk right now on the gold is huge because where the jurisdiction you're in. So it's hard to find players who are in North America, but Australia, places like that are more stable geopolitical jurisdictions as well.
What kind of gold exposure do you have on behalf of clients?
I'd say in an equity account, we're probably sitting around 5%. So it's not excessive, but it's just enough to, be a hedge there. It's not, it still is, it's the store value. It is a bit of a hedge in the portfolio against everything else, which it did work out in the first quarter. So we like it that way.
That's John Zechner.